Welcome to the Mortgage Guy Podcast with your host, Darian Newlick, where I will educate you on mortgages and real estate done right. Hello, everyone, and welcome again to the Mortgage Guy Podcast, episode 2. So today, we are in our guideline series where we are going over the different mortgage insuring entities out there that have programs such as Fannie Mae, Freddie Mac, FHA, VA, all the ones that you've heard of. And basically what we're doing is we're starting here by going through the guidelines. And we are doing that because, frankly, I've never seen it done before. Yes, it can be a little boring, but at the end of the day, we are going right to the handbook to see if you qualify or what you need to do to qualify, and just key bits of information that I see on a routine basis. I just want to go over the key points, of course, but these weeks are going to be about finding that information for you so that you don't have to worry about talking necessarily to the lender to find the information. We need the lender to be able to obtain financing. But this way you go into that conversation with the loan officer and you already have a good idea of if you qualify or if you don't. Again, I'm going over key points, so what that means is that we're not going to be going over everything. There's a lot in these guidelines, tons of information. We could spend hours on hours of time just going through every single one of these pages, even just for the eligibility standpoint. But we're not going to go through all of that. We don't have the time to do that. That'd be a lot of me sitting here reading word by word, line by line. Don't want to do that. Again, key points. If you have something in particular that I have not gone over or that you want clarification on, drop a comment in the comment section below. Or what I strongly recommend, I'll get back to you sooner, is if you were able to direct message me at one of my social media accounts. So we're going to get into it here. Today is Freddie Mac. So we're going over the conventional entities. Last week was Fannie Mae. This week is Freddie Mac. So we went over the girl, now we're going over the guy. Fannie, now Freddie. And so there's some slight differences. Definitely you'll see in certain parts. But for the most part, again, there's a lot of similarities because they are conventional loans. So a lot of the guidelines tend to be very similar or just like little minor tweaks per se. So we're just going to jump right into it. Again, follow along on my YouTube channel as I go through certain pages. This week I have actually changed out, or I re-downloaded the handbook for just the particular sections that we're going over so that I'm not scrolling as much. Still have a decent amount to scroll through, but want to make sure that I can eliminate some of that. So starting here, if you look on the YouTube channel, we're going to get going. So here, chapter 1101, this is actually pages 2 through 5, these first couple pages of the actual Freddie Mac handbook. So if you look here, there's basically the whole point of these first couple pages is just to show you there's, again, 3 segments. We're not going over all 3 segments. We're just going over the selling segment. So if you look down here, there's a seller-servicer relationship segment. We're not going over that. There's nothing to do with qualifying, eligibility. There might be some little key parts in there specific for a lender or me as a loan officer to know, but not something that really is a key point that has anything to do with you qualifying. Selling, as far as selling goes, that's all the eligibility, everything that we're looking for. Mortgage eligibility, origination and underwriting, selling and delivery. That's where everything is involved at. Now, the last one is servicing. There are some back-end requirements that could, again, just like the beginning, pertain to you, but it's very, very minimal, non-key information as far as just the basics of do you qualify, or what's the basic information for me to know if I want or should obtain, or if that's the better product for me to do a Freddie Mac mortgage over a Fannie or an FHA or a VA or whatever it may be. So again, we're going over just this selling part. The key points are all in the selling. They're not in these other parts. Certainly I can spend hours again relating all those things, but we're not going to do that. So going to go on through here. I just wanted to go over that key part for you. So now we're jumping in. So these are chapters 4,000 through 6,000. Those are the chapters that we are going over. So you'll start to see me kind of scroll through these beginning chapters. If you saw at the top, uniform instruments, that's just like, again, the mortgage application. Nothing there. That's very key for us to really go over. So scrolling through, again, you'll kind of watch me as I scroll through a handful of times. It just is what it is, trying to get to the main key parts. Here, chapter 4201, general mortgage eligibility. So again, you actually saw the same thing with Fannie Mae. They lend on an investment quality mortgage. There we go. Basically, an investment quality mortgage is a mortgage that is made to a borrower from whom repayment of the debt can be expected. You're going to pay the debt, secured by real property, and you're a person. Okay? You're not a business or an entity. You're a person. Okay? So go on down here, just some other key points. So when you see mortgage valid first lien, no prior liens, mortgage not modified. So this is a first lien mortgage. This is not a second mortgage that we're getting. So Freddie Mac, Fannie Mae, all the entities are solely first lien mortgages. So then we look at the mortgage process, or the mortgage premises must be free and clear of all prior liens and encumbrances, and no rights or condition may exist that could give rise to such liens except. So in other words, if you're going to buy the property, there shouldn't be any liens, judgments, encumbrances, anything like that. Or at least some sort of documentation if there's like an easement and there's like an actual documented accepted agreement that you're allowed or granting access to X portion of the property, such as a lot of that is with like a driveway. So for all intents and purposes, we're going to go here. So liens for real estate taxes, special assessments, not yet due and payable. If there's obviously real estate taxes that would have been liens, they're not due yet. Again, there's an exception right there. And another thing, if you are refinancing, just know you have to pay off any sort of lien or judgment or anything that is against you with the county, on your property, anything like that. So a couple key little parts right there. Terms, you can go up to 30 years. So we can't go more than 30 years. It's a standard loan. Mortgage not in default. You want to make sure that, again, your mortgage is not in default. So no part of the borrower's monthly installment of principal and interest, and if applicable, monthly escrow payment may have been 30 days or more delinquent. See definition of delinquency. We got to look more at the delinquency, what that definition is. And so this is during the immediate 12 months before the delivery date. So you have to look at when the loan is, so once you sign that loan, that mortgage note, then the loan is delivered. So whatever that delivery date is, we might as well just take the note date at that point, 12 months. Now, again, there are certain instances where you can actually have a couple mortgage lates. We'll go over those. There may have not been any other default under the terms and conditions of the mortgage that remain uncured, 30 days or more. So basically, you have to be current. You cannot not be current. So if you are trying to refinance your home, essentially is what that's saying, and you are past due 2 months, you're not refinancing your home. You have to bring everything current. And you get to, so all costs, fees, and expenses incurred in making. So basically what this means is in closing and recording, the mortgage must have been paid. That just means that, you know, when you're going to refinance, do a purchase transaction, that you're going to make sure all of those liens, judgments, anything against the property, or even with the county, or even IRS, things like that, they all have to be paid before you can close the loan. Again, certain exceptions to that, but there we go. So going to scroll on down here. Location of the mortgage premises has to be located in a state. Figured I'd point that out just in case you were thinking about out of the country. That does not work. Mortgages secured by primary residences. Owner occupied, individuals. So what that means, so individual, borrower is an individual. It's not a business. So this isn't Joe's LLC or the Crab Shack, whatever. This is an actual person that you can document through your driver's license, things like that. And you're going to occupy all or part of the mortgage premises as a primary residence. If it's part, it's got to be 51% or more, so there's got to be some sort of justifiable reason there. All right, move on to, so that's primary residence. Second home, you can also get a second home mortgage through Freddie Mac as well. 1 unit property, must occupy the second home for some portion of the year. It's not really a whole lot of ability to prove that, okay? May rent the property on a short-term basis, provided that the property is not subject to any rental pools or agreements that require the borrower to rent the property, give a management company or entity control over the occupancy of the property, or involve revenue sharing between any owners and developer or another party. HOA dues can be okay. I would kind of stay away from certain condos. Preferred, I would say probably go for more of a townhome-esque. More of that site condo townhome is what they're looking for, because you actually own the land, you own the property, it's yours. You're just, what you are obligated to is just the encumbrances and covenants of, the covenants of the homeowners association. Whereas if you're a condo, you may own the structure, but you're not taxed on the land. You don't own that land. So they do have certain rights in that situation that they could take over. So you just got to look a little bit more into it. Just moving on here, the mortgage premises must be in such a location to function reasonably as a second home. This is the key part of this whole thing. One unit, I can't really prove that you're going to occupy the property as a second home for a portion of the year. We just kind of have to take your word for it as a lender. And then this part, function reasonably. So this is where I just tell everyone, if you're looking for a second home, the lender is going to use just common sense. If you're going to buy a property in Florida and you live in Ohio, that would constitute as a second home, because Florida itself is a common vacation area. If you are in Ohio and you are going to rent at a site like a campground or some sort of like around a campground, sometimes that could work, or like a designated national park, something of that sort, that would sort of work. But if we're just talking down the road because it's on a lake down the road, that's not going to work as a second home. So we have to use common sense in that. If it's just a home not even on a lake down the road or in the city, clearly that's not a second home. That's an investment property. So any lender is going to use common sense in that to say, okay, this is a second home or not, based on what we see. That's all that we can do. Must be suited for year-round occupancy. Second home with seasonal limitations, 1 year-round occupancy. So basically, you just have to make sure that the property can be occupied for the entire year. You do have the ability in some cases to actually rent out the property, but it's got to be more of, we're looking more from the second home standpoint that you're doing it with like an Airbnb, for example. So temporary rentals, not a full year term rental. Because once we would figure that out, you would not be able to utilize that as a second home. Second home's more from the standpoint, if you're looking at it from a purchase side. From a refinance, you almost want it to be an investment property if you have rental income. So it just kind of depends on how you want it to be viewed. Again, from a purchase standpoint, no lender's going to want to view this as a investment property, because if we do, then we have to put you in a position where you have investment pricing, and investment properties, we have to prove a market analysis. So we have to get additional, basically a $150 to $200 market analysis to tell us what the rental amount is going to be if it's an investment property. But if you're sticking with that second home, I'm not proving rental income. You're just buying it as a second home. So you're good. There's a lot of kind of leeway there. It's just more of on the, if this is a property and you're trying to refinance it, that's where you may have some more that you have to prove. Going down here, the property must not be subject to any time sharing or other shared ownership arrangement. It's got to be yours. Determination on whether a property is a second home is conclusive. A 2-unit property used as a second home is considered an investment property. So again, 1 unit only. Special underwriting requirements. For newly constructed homes that are purchase transactions, the borrower may not be affiliated or related to the builder, developer, or property seller. Each borrower, individual, and all borrowers collectively must not be obligated on more than 10 1 to 4 unit finance properties, including the subject property and the borrower's primary residence, provided that when the number of 1 to 4 unit finance properties, including the subject property and the borrower's primary residence, is greater than 6, the mortgage must have a 720 credit score. It must have a pass. Basically, they say you can't manual underwrite. There's very few lenders out there who will actually manually underwrite a conventional loan. It's very rare and very uncommon. So I would just say, looking 720, standard approve eligible. That's all we're looking. These do not include, so the ones that I would say here, so when you look at multifamily 5 or more units, that's not a Fannie Mae, a standard conventional style mortgage. That's a non-qualified or even commercial style mortgage. So that's why these don't qualify, because you don't have a government-backed loan on either of these. Commercial, multifamily. The commercial is usually against a business. Timeshares, what a timeshare basically is viewed as. What a timeshare is viewed as, it's viewed as basically an installment debt. So it's like, hey, I'm paying this installment debt on a monthly basis so I can use it a couple times a year. It's not viewed as actual physical real estate that you own. So keep that in mind. Timeshares don't have to include undeveloped land. You're fine. Manufactured homes not titled as real property. So that's like I'm leasing a plot, a concrete slab in this manufactured community, and I've got this secured loan against the manufactured home because you're not going to have a mortgage against it. Just things like that. You're going to have reserve requirements. You typically want upwards of 4 to 6 months. You could probably get it done with 2 to 3 most often, but I'd say try to shoot for those 4 to 6. Rental income from the borrower's second home, it may not be considered, so you can't use rental income for the borrower's second home. Monthly housing expense related to the borrower's current primary residence, so that's key. So the monthly housing expense, we have to make sure that that's included in your front end ratio. So I can't just say, oh, your $1,000 is your only housing expense and then you have all this other debt to income. What you're actually doing as a lender, if you see in the second part, the monthly payment amount on the second home must be considered in calculating the debt payment to income ratio. There you go. And so that's your overall. So you have a front end, which is your housing, the back end, which is your debt. So when you look at a second home, you're looking at your primary mortgage payment as the housing expense, and you're looking at this payment in the back end debt to income ratio. So the overall debt to income ratio. That's how this is going to be calculated. So you're actually taking, typically, if you're getting a second home, you have a higher first payment. So that higher first payment is the one that we count, not the lower. So that's the idea behind that. You could also get an investment property mortgage. Moving on now, again, no more than 10, greater than 6, have to have a 720. Don't have to include same types of properties, a lot of the same stuff, additional documentation requirement. Just one key thing, it's a 1 to 4 family. You can't go higher than 1 to 4. If you look at, when you look at investment properties and second homes, and then you look at primary residences, best pricing, primary residence. It's the one that's gonna have the least amount of default. A second home is gonna be the second because that's one you routinely will visit throughout the year, less than 50% of the time, quote unquote. No one knows once you actually close the loan though, and you actually own the property, you live there. But that's gonna have a not as good pricing as your primary, but then you're gonna have investment property, which that's gonna be the property you're gonna let go the first. So if something happens, some sort of hardship, you're letting your investment property go before you let your second home and before you let your actual primary residence. Because those two properties you actually visit, frequent, they're considered homes, like your home. And then you have this investment property, which is considered, okay, yeah, I'm generating income from it, but at the same time, I'm probably gonna let that one go because I'm not necessarily tied to it. I want my lake house. I want my, standard home that I live in with my family. But this investment property over here, I can't afford to keep it up. I'm letting that one go. That's the mindset behind these governing entities. So there is worse pricing as you go from primary to secondary to investment. Going on down here, so we're gonna move on a little bit slower than I thought going through today. All right, on a great track. Points and fees limitation, same thing. You can only charge up to 3%. There's a 2% exclusion that you're able to actually get or have an ability to buy down the rate a little bit more. It just depends on the actual price out when a mortgage loan officer will go to price out your loan. So once they have the application, they have all your documentation, everything's entered in correctly. Hopefully they did that. And we're not cutting corners. Any loan officers out there, don't cut corners. Big issue today. But if you go price it out, everything's in there correctly, there's certain instances, again, where you can buy the rate down because you get this additional exclusion. I forgot what they called it in here, but we can exclude 2%, and that's why they say 5% total. So it just gives you that ability. In certain instances, it depends on once you actually price out the loan and you have all the information there. So moving on, again, value, the value we get to use for your property, this is more from a purchase standpoint, it's the lesser of the appraised value or the purchase price. Loan product advisor may accept the value to the seller provided. So the key thing I just kind of wanted to go over here is that basically you can get an appraisal waiver in certain instances. If we accept an appraised value, it just depends. So automated collateral evaluation, they're talking more on the standpoint of you have an appraisal waiver. So certain instances you can get that. So moving on down here. So we're kind of in this LTV ratio standpoint. So one key thing, so for example, 94.01% will be rounded up to 95. The only reason why I wanted to point that out is so from a pricing standpoint, so there's different buckets or different tiers. I think I mentioned that before. So if you're 90 to 94%, that's a certain tier per se. But if you look here, for example, 94.01%, they always round that up to the nearest percent. So it would be 95. So 94 is looked at as 95. So it has that pricing tier, that loan to value tier, that mortgage insurance tier of that 95% right there. So scrolling down, maximum original loan amounts for home mortgage purchases. This is outdated. Just know, key thing is there's county limits. So you can just go Google what the conventional county limits are. You'll be able to find them online for every county of every area. There's a standard across the board. I believe it's 530 and some change right now. And then you also have higher price mortgage loans or high cost areas, which they exceed that amount. So it just depends. This is the old one, again, from 2019. You saw 484 was across the country, 726 for these particular properties. But as you look up today, you can, again, just simply Google conventional loan limits and for 2021, and you'll be able to pull it up. You'll be able to find it for every single area. Moving on down, maximum loan to value. Again, just kind of down here, you have 95. So there's actually 97% you can go up to. They're separate programs. You're at Home Ready. I'm sorry, Home Possible for Freddie. Home Ready is the Fannie one. So a lot of what Fannie has, Freddie also has. They just have their own version. Home Ready, and then this one's Home Possible with Freddie. Could do 97%. That's a little bit better than the Home One, which I will talk about in a little bit as well. Home One is if you're a first-time home buyer only. So certain instances you can go to 97%. A refinance is also up to 97%. But if you are not a first-time home buyer or you do not qualify at the 3% for Home Possible or Home Ready, if it was Fannie, then 95% is the maximum. 2-unit is 85%, so you can put down 15% with Freddie. 3 to 4 unit is 80%. Second home is 90, so look at that. It's only 10% down for doing a second home. 1-unit investment is 15. I'll tell you right now, you're not getting a 1-unit investment property with 15% down in this market, because the maximum, there's a cap of 2% for fees. that you can get from as in seller paid right now on investment properties for both Fannie and Freddie. So if you go to buy an investment property, you take the highest rate that you can get. Fannie and Freddie are both discouraging the buying of investment properties right now. So it used to be a little bit better. It has been in the past. They definitely want you to have a shorter term. So if you're looking at investment property, definitely go for more of that 15-year term. You might need to go that low, especially if you even want to consider 15% down. It sounds good, but when the highest on the rate scale, when the highest rate is charging you 4, 5, 3 points, whatever, there's no, it's hard to make that work, to make that property work to where you're going to pass the fee test. That's almost all day long going to be hitting the high price mortgage loan limits. So you want to make sure that you stay away from that, because it will just fail when that test is ran for HPML every time. There is a requirement that you can't charge X amount, 3%. And the majority of the time you're charging more than 3%. So it just depends. There are some instances, I would say it's 95% unlikely, but if you do get a very high priced investment property, you might be able to get that to fly with the 2% seller credits. But ideally you want to be at least 20% down, and even more so, I would say put 25 or 30% down. The pricing is just that much better. 2 to 4 unit, 25% down. Cash out refinances, 80% max. It used to be 85. A lot of entities have gotten away from that just because due to the default rates, the economy, people want to make sure that if they need to sell the property, they can actually make most of their money back. Right now, we are in a spending crisis in our economy, so I'm assuming that's got something to do with it. The mortgage market does affect a lot of what happens in the overall economy. So that would equally make sense, seeing how spend happy we have been as Americans, myself included. Cash out refinance, so again, 80%. 2 to 4 units, 75. Second home, you can get up to 75%. 1 unit, 75. Investment in 70%. So those are the refinance maximums that you can go up to cash out. Secondary financing, so let's go through here. I don't think there was anything. For secondary financing, there are some programs out there. I would just say it just depends on the particular program. There's a lot of down payment assistance, or you can call it secondary financing, whatever you want. That's essentially what your secondary financing is for, assisting you with the down payment. The majority of that, again, it just depends on the program, the state program, which one you use. There's some so there's non-state programs and state programs. Always prefer to go to the non-state program. State programs in this market, probably for the next 5 to 10 years, you're not going to get those contracts accepted, because they're 45 to 60-day closings on average, because you're not underwriting necessarily that fully in-house. Part of the processing is that you have to send it out to that government department, and they have a processing, or they have to process that assistance, that down payment assistance loan as well. So you have to correspond with them. The non-state programs, you're typically underwriting in-house. Or if you have your own in-house down payment assistance program, some lenders have that as well. You want to utilize those more often, because you can actually close in 30 days on a routine basis, not in a high volume basis. You might be 35 to 40 days, but those contracts are getting accepted now, which is great. When you go to the state programs, again, you're 45, 60 days on a routine basis. So to try to say that those are going to close in 30 in a high volume time is very, very unlikely. We are still in a relatively high volume. We still have a lot of refinances being done in the mortgage industry. We still have a lot of purchases. Even with the lack of homes, mortgage applications have not had a massive change from the beginning and middle of COVID. They're still moving and chugging along, and I do believe that we're going to see a lot more houses slowly pop on the market, or additional alternative financing take place as well. Just another key program here, Native American mortgages, Section 184. Just know that there are special programs for Native Americans out there. If you are one, I would definitely look into that, Section 184 Native American mortgages. You can do that for multiple programs from Fannie, Freddie, FHA, VA. I just saw it in there, so I wanted to point it out. Refinance mortgages. So refinance, this is the same thing for the most part as Fannie, as we went over last time. So you have basically a rate and term mortgage, or what's called a no cash out mortgage. You have a cash out mortgage, so you're pulling out cash, and then a special purpose cash out refinance. I'll get into those in a minute. Now you can also use this to pay off interim construction financing. So basically, if you're going to go build a home, you buy the land, you do what's called a bridge loan first. Then after that build is complete, the project's complete, you then go to convert that interim or bridge loan into a traditional standard mortgage. So that's considered a refinance of that bridge loan. That is a no cash out refinance. You're paying off that construction loan. Construction, conversion, renovation. So basically, for the most part, renovation is the one that most people would consider. So if you're doing a renovation loan, it's a no cash out refinance, because you are now doing the renovations to your property and you're financing the aftermarket value. So they look at that as lumping it in, not as giving you cash, but as a no cash out. We did these improvements, not us ourselves. We didn't pull out cash to do those improvements, but we are now lending. It's like a redoing of the value, the title, the deed, the property. It's almost looked at like a new purchase, but it's still structured as a refinance. So they view that as, hey, here's this property. You're just reevaluating, redoing the property. We're still going to lend to you, and so we're allowed to go up to 97% on that as well. All right, so those are the three that we got there. Again, you can use the proceeds to pay off existing mortgages if you're just doing a straight refinance. Any existing mortgages that are used in conjunction with obtaining the property. So if you have a mortgage, you took out a line of credit 6 months later, you can only pay off the first mortgage, and you have to subordinate that line of credit, and hopefully they're willing to do that, or they're not a hassle. Certainly we have time with a refinance. Mortgage secured premises. So you can also do so when you go to refinance a property where you physically own the property outright, you'd want to pull cash out. That is a cash out refinance. They don't look at that as a rate and term. There's no redoing of the property itself. So in light of that, they view that as a cash out. We're just pulling out cash to do whatever it is we want to do, because you may want to use the nice low rates of a mortgage versus a personal loan at 8, 10, 12, 15, whatever may be the percentage there. So general requirements, there's some key things. At least one borrower on the refinance mortgage must be actually refinancing it. So if you were at least on the original note, you're good. At least one borrower on the refinance mortgage held title. So at least one of the borrowers have to have held title and resided in the mortgage premises as a primary resident for the most recent 12-month period. And the mortgage file contains documentation evidencing that the borrower either has been making timely mortgage payments, so we're going to see that on your credit report, including the payments of any secondary financing, so if you had a second mortgage for the most recent 12 months as well. So they want to add that in because it's overall housing expense. At least one borrower on the refinance mortgage inherited or was legally awarded the mortgage premises, so from like a divorce, a separation, dissolution of marriage, whatever it may be. Living trust may be irrevocable, so you can't revoke that trust by a settler's death. To be an eligible borrower at the time of the refinance transaction, the borrower must continue to be a living trust that meets Freddie Mac's revocability and, as applicable, other eligibility requirements. Okay, so you don't want to be in a trust that can be revoked. That's basically the way you want to look at it. You want it to be irrevocable, so not revocable. So it's in place. It's set. There's nothing changing this. So that's the way you want to view it. So going down here, we don't have to worry about refinance practices. We're looking at eligibility, qualification, keynotes for you. So no cash out, pay off first lien, pay off any junior liens that were used to acquire the property, pay related closing costs, disperse cash. Up to, so this is kind of cool. If you do just a rate and term mortgage, you pay off your closing costs, you lump it all into the mortgage like most people do, you can actually get up to 1% of the new refinanced mortgage or $2,000, whichever's less. So there you go. That's just a cool little, if you want some extra cash, you can get a little bit extra. You'll get your escrow refund, and you'll also be able to get a deferred payment. We call it a skip payment because it sounds better, but it's really deferred. It just sets your mortgage back 1 month because you skip the first of the following month. I do like the aspect of skip though, because if you think about it, your mortgage is not going to be paid anytime soon. We're talking 30 years down the road, so who cares? I mean, one payment is what we're really talking about. I would view that more as a skip payment for myself because I'm probably going to sell my home unless this is my forever home that I am in. That 1 month reprieve is very nice. Pay off the outstanding balance of a land contract or contract for a deed. Basically the renovation product. There's only a couple companies in the country, maybe 1 to 3% of all renovations done are actually the Freddie or Fannie renovation product. Most people utilize the FHA renovation product because it was, to be honest, I honestly don't know why it's not a great product. It does have its place, but then you have the Fannie and Freddie, and so this is Freddie's version, the choice renovation. There's also the home style renovation with Fannie. We'll get into renovations a little bit more later on in another segment, but just know, can do a renovation, pay off existing mortgage debt with that, and finance those renovations as a rate and term mortgage. There's not that many companies that offer a conventional based renovation product. Let's just say maybe 10% of lenders actively do 1 to 5 renovations a year. Most of them are linked up with the FHA, and probably half of those, or 5%, maybe even half of that, maybe a quarter, even offer the conventional product. There's not that many companies that do or that actively use it per se. So that is kind of a hard to find. So cash out refinance. None of the borrowers have been on title to the subject property for at least 6 months prior to the note date of the cash out refinance mortgage. The following requirements must be met. So they want to see that you've been on title for at least 6 months. But if you weren't, at least one has to be met. At least one borrower on the refinance mortgage inherited or was legally awarded the subject property, like a divorce, something like that. Or all of the following. No financing secured by the subject property was used to purchase the subject property. Owner, so the preliminary title report for the refinance transaction must reflect the borrower as the owner of the subject property, have to be the owner, and there's no liens on the property. Source of funds used to purchase the subject property must be fully documented. You must not exceed the sum of the original purchase price and related closing costs as documented by the settlement or closing disclosure statement, and there's no relationship with the buyer-seller of the purchase transaction. All right, let's move on down. So special purpose cash out refinance mortgage. Buy out the equity of a co-owner is what they constitute as a special purpose. So the loan amount of a special purpose cash out refinance mortgage is limited to amounts. So we have limited amounts that we could use it for. Paying off the first mortgage regardless of age, junior liens secured by the mortgage premises, paying related closing costs. In addition, the following conditions must be met. The borrower and the co-owner receiving the buyout proceeds must have jointly owned the property for a minimum of 12 months prior to the initial loan application. Borrower and the co-owner receiving the buyout proceeds must provide evidence that they occupied the subject property as their primary residence. So a couple key points there. If you want to read through more of this, this is not that common, but I thought it was still good to know. Special purpose cash out refinance, buying out. You are buying out the equity of a co-owner. There we go. Not going to go through that. Down here, going to keep on moving. Here we go. Chapter. So these are just going to be the next couple ones. I believe are just some other products that they offer. Freddie Mac Relief Refinance Mortgages. This one says if it's the same servicer. We're going to keep on going through to the next one. We're going to find here. This one had a lot to it, I remember. Got a lot in here. You're also going to see the next one, open access. So just think relief, refinance. They both said relief in there, so just think relief. So when you are doing a relief, relief is for if you're refinancing. So it's just refinance based. For those ones, getting through here. Enhanced relief. So these ones that I'm going over, those three in particular, are for if you have a higher interest rate or you didn't take advantage of the market at a certain period of time. They offer incentives for you to refinance. Basically, it's a way to stimulate the economy. So they understand they're essentially going to get paid less money per month. Or the lender's going to essentially get paid less money per month, but they're opening opportunities to stimulate the economy by offering these types of mortgages in the event that you did not take advantage of the market at that time. That's why they're only refinance based. It's not for purchases, just refinances. Give you a break on mortgage insurance, give you a break on interest rate. They're good programs. And most of them come with what are called those appraisal waivers. Not all of them, but most of them come with appraisal waivers where no appraisal is needed, you just change those terms, which is nice. So definitely look into relief refinances if you have, I would just say, if you have an interest rate of 3.875 or higher in this current market, so we're June 18 of 2021, I would look into refinancing if you haven't recently. Definitely take advantage of the market. Home Possible Mortgages. So this is a key program. I use this one so much. So this Home Possible has Home Possible Advantage. So just so you know, Advantage means you're doing the 97% financing. So that's 3% down plus your closing costs. We're always going to do plus your closing costs. I'm going to try to remember to do that every time, because every time someone likes to say, "Oh, I thought that was only 5% or 3% or 10% or whatever it may be on the program," they think it's only 3 or 5 or 10 or whatever percent it is, and they disregard the closing costs and wonder, why are my costs so high? Happens all the time. Some of you are definitely thinking that. When you get that estimate, or that quote, and you said, "Oh, this $100,000 purchase price, 5% is $5,000. Why am I bringing $8,900 or $11,000 to the closing table?" Because it's 5% or 3% or whatever it is, plus your closing costs. Always remember that. So many people do not know that. I have been proven and shocked time after time again over that. So just know that's what it means. So 3% down, 97% financing. Fixed rate. There are some adjustable rate mortgages. Do not do an adjustable rate mortgage in this market. They have terrible pricing. Rates are worse than fixed rate mortgages. They will be for some time to come. Do not want to do an ARM. 1 to 4 unit properties only, other than manufactured home. There are certain instances you can get a manufactured home. Manufactured homes are not common loans, so I'm not going to go over manufactured homes. Ineligible mortgages. Just know that there's ineligible. You can't do basically you can't do one of these other special programs and do a special program as Home Possible. You can only do one. So you can either do Home Possible, you can do this one, you can do this Native American loan. So you can't have like multiple you can't like stack your incentives is basically what they're saying. So that's why these are all ineligible over here. with Home Possible, key thing is you get a very big break on your mortgage insurance and on your interest rate and the pricing of that interest rate. So there's very, very nice incentives there for you to do a Home Possible mortgage if you qualify for it. That's why I love this program. Whether it's Home Ready for Fannie or Home Possible for Freddie. Home Possible, it's a purchase transaction or a no cash out refinance transaction. So you can do a no cash out refinance. You're just refinancing the original mortgage on it. That does work. It does not have a requirement. Keynote, it does not have a requirement that it has to be a Freddie Mac mortgage. That is very, very key. These other relief refinance programs, they require them to be Freddie Mac based mortgages, and then Fannie has their product. But still, at the same time, there's instances where some will qualify Freddie where they don't qualify Fannie. A lot of that's more of like a student loan thing. That's the main one, but there are certain instances in that. So we'll go down here, get 1 to 4 unit primary residence. Gonna keep going on. Cash out, refinance transactions are not eligible. Second home's not eligible. Eligible sources of funds used to qualify the borrower for the mortgage transaction. Are those permitted for Home Possible mortgages? That didn't really make a whole lot of sense there. Warranty relief, appraisal waivers. You can get appraisal waivers with these mortgages. Again, both on purchase and refinance transactions. Here's the key one, is the income limits. This is the biggest deciding factor of if you qualify for a Home Possible mortgage or not. So income limits, the borrower's qualifying income converted to an annual basis must not exceed 100% of the area median income for the location of the mortgage premises. Okay. So you have to look that up right here, Home Possible income and property eligibility tool. You can go to Google and you can just type in Home Possible income limits, or Home Ready if you're looking at Fannie's income limits. Take a look, see if you qualify. Just give you an opportunity there. Going through here, at least one borrower must occupy the property. There are opportunities for non-occupying co-borrowers here, where you actually don't have to consider their income towards that income limit, things like that. It's only for a 1 unit property. That's kind of the key one. And then you also have, well, that's basically the key part, is 1 unit property. We're gonna go on down. Let's go on down to some other stuff. Ownership of the property. The occupying borrowers must not have an ownership interest in more than 2 financed residential properties. So if you have 3 or 4, you can't do the Home Possible, including the subject property too. So make sure you keep note. It's not just 2 other, it's 2 total. Go through here, we're going to see qualifying ratios, rental income. So basically this is the key part, rental income. You can use rental income from 1 unit primary residence, but that's not common. I'll just say that. Usually it's, I mean, if you're doing a refinance, you're doing a no cash out refinance, you already got qualified once. We don't need the rental income. And then also from the standpoint, if you're buying the home, I'm not using that rental income on that property because you're buying it as a primary residence. You're not buying it to rent. So there's very, very few instances, not common. But qualifying ratios, there's no maximum monthly housing expense. So just keep in mind, there's no front end housing expense with the Home Possible. So if you're 43, 43, 45, 45, 46, 46, you're fine. I will say it's really hard to get done. They're gonna almost base the debt to income more on the front end than they are on the back, but at the same time, you can go up to 50. So you can go up to 50%. They say determined by LP or loan product advisor, just for the sole fact that on a very, very rare occasion, you can get an approval above 50% for a conventional loan. And some lenders will actually accept that. They won't cap you at 45, 47, or 50. Some will go above, but it's very, very rare that you have that above. One of the new relief refinance programs does allow you to actually go to 65%. So no cap, 65%, that's an opportunity to really get a lot of people to refinance their current Fannie and Freddie mortgages. Loan to values, again, 97, 95, 95. So there's some key parts there for you on the maximums. So super conforming, just so you know, there is no 3% down option on super conforming. That's basically if you're above the standard loan limit. So there's designated high cost areas. If you're in a designated high cost area, so you'll see most of the areas are going to be 535 or 530 and some change around the country with today's loan limit. But if you see anything above that, that's considered a high cost area. No matter what it is above, it could be 600, 700, 800, depending on the area. Once it's high cost, it's considered a super conforming. So if it's a high cost area, you can only put down 5%. 2 unit is 15, 3 to 4 is 20. So there are a lot of incentives to not keep it or not put it in a super conforming, because even with 3 to 4 unit, you can, if it's your primary residence, you only need 5% down, 5% for 2 unit. That's really good. Borrower contribution. So this is key. If you have someone to give you a gift, we don't have to prove anything for a home possible mortgage on a 1 unit. This is predominantly done for a 1 unit, but you can do manufactured, can do 2 to 4 unit. There you go. But you're looking at no required funds. Borrower personal funds, you can get it all gift. Reserves, some will have reserves, but I would say predominantly you're going to look at most of them are going to be none. So usually they just want you to have the money for the down payment. Always recommend having 2 to 3, but there you go. Sources of funds, personal funds, minimum down payment, but you can get a gift for that as well. There is none required. So 80 is greater than or equal to. It is greater than 95, none. 3% down, none required. So that is very nice. Now, borrower's personal funds, don't take out a loan. Just please don't take out a loan. We're not going to look at a loan very nicely for you. You can't use those funds. A lot of people don't know that as well. So you can't go out, get a personal loan, and then use that money for the down payment. We will source the funds to make sure over the past 2 months, usually in conventional, you can get by with 1 month of bank statements, but just figure the past 2-3 months, we're going to look back, see if any loans were taken out to buy that home. So you want to make sure that no loans, and if we look at your credit report and we see a $8,000 loan that was taken out 3 months ago, the underwriter is going to request everything from 3 months ago, and they're going to source all of that money. So just keep that in mind as well. Mortgage insurance, you have a special incentive. There's a home ownership education standpoint. It is nice for Freddie because you don't actually have to pay anything for their home ownership education course. Where Fannie Mae, you do have to pay, I think it's $50 to $100. So it just saves you some upfront costs there. If you're buying a 2 to 4 unit, you do have to do a landlord education. So scrolling on through here, those are the key parts there. Nothing really more else on the home possible front. You can do construction, conversion, renovation mortgages. Again here, those are rate and term mortgages. It's construction conversion, is that converting from a bridge loan. Super conforming, designated high cost areas. Just Google the loan limits. So like if it was 726, that would be a high cost area. You can look up the county loan limits here as well. This one's again for 2019, but you can just Google 2021. You'll be able to find it with the FHFA.gov. Let's go on down here. Some of these are just other programs. Eligible affordable merit rate. I've never actually utilized that one before. They have Freddie Mac Home One. Freddie Mac Home One's the old first-time home buyer program. They still have it. Just to let you know, no one ever wants to do that program. It is not a good program. Your mortgage insurance is so, I've never seen it so high. I don't care what your credit score is. You could have a 780 credit score. Your mortgage insurance is still going to be through the roof. You might as well just do an FHA loan at that point. And then also your interest rates are not very good. You get a large hit for just 2% that you could save up and put down extra yourself. Or just take a higher rate and then just get some lender credits to cover a portion. Do what you gotta do, but I do not recommend doing that program. Freddie Mac, choice renovation. So again, there's a renovation product for us. Scroll on through. Mortgage insurance, late charges. So this just lets you know, so on a standard loan, you're looking at 6% is your coverage, 6% of the loan amount, loan to value, and then if it's in this criteria, 12%, 25, and then you see 35%. 35 if it's between 95 and 90, or 95.01 and 97%. That's so, the mortgage insurance on 35% is so high. And then there's customs, and so this is Home Possible. It's only 25%. That is nice. That is very, very nice. I'd say these customs, I wouldn't even consider these. These are pretty out of the norm instances. Mortgage insurance, you actually have options. So a lot of people don't know this, and a lot of people take advantage of it. So you have your monthly. You could do the monthly mortgage insurance, but you could also do a single premium. So what they allow you to do is, let's say you would spend $10,000 in mortgage insurance over the course of your term. They'll let you buy it out for a one-time premium for X amount of dollars. We'll just call it 30%. And then also you could do a combination. You could do a split premium. So you could put down 1%. Sometimes there's some other options of like 1.5% or whatever it may be, and then you're just reducing that monthly obligation that you have. So you're paying off a portion of it. So they do give you options there to reduce your mortgage insurance up front. I highly recommend taking advantage of those. They do save you a lot of money in that mortgage insurance. If you're utilizing the lower loan amounts, then sometimes, and you have a higher credit score, especially if the mortgage insurance is so low, it depends on how much you're putting down, if it's even worth it or not. I would say if you're going to put down less than 10%, then you typically want to buy it out because it's going to be so extensive. But if you put down more than 10%, the mortgage insurance tends to be so cheap that if you're going to spend $20 over the course of whatever 4 years, and your mortgage is going to get paid down and then it falls off, you're not going to spend that much money to where it doesn't really actually make sense to buy out that mortgage insurance. So let the loan officer evaluate that borrower credit worthiness. So when we're looking here at methods of underwriting, they're looking at your credit worthiness, your layering of risk, so the risk that's involved. A lot of that is all spit out through the automated underwriting system. So it's LP, or loan processor, for Freddie Mac. Age of documentation, 120 days before the applicable note date. So you can actually buy a home with a non-occupying co-borrower. Again, that's totally fine. So for accept mortgages, that means you actually have an approve eligible. We call it accept eligible with LP. The seller is not, or the lender is not required to calculate or evaluate the occupant borrower's monthly housing expense to income ratio, or the occupant borrower's monthly debt to income ratio. So we're not required to actually calculate that into the factor if they're a non-occupying co-borrower. So that can actually help you qualify for a little bit more. That actually helps you. Permanent, non-permanent resident aliens. Again, same thing with Fannie. I would just say you only need 1 year of work history. That is very nice. Non-U.S. citizen is the same terms as a U.S. citizen. There you go. Very nice. So you can get a mortgage and have worked only 1 year. And I do it all the time. There's actually a very big Nigerian population in Indiana where I do a lot of those. And even in Florida, I've done some people from Cuba. That was pretty cool. Parent or disabled child occupying mortgage premises. So if you do have a disabled child, just key point here, this is actually really good to know. A borrower may be considered as an occupying borrower for purposes of the guide if mortgage premises is occupied as a primary residence by an individual who is the borrower's parents. So if your child has a disability you can be an occupying co-borrower or an occupying borrower on that transaction. Has a disability and the borrower is the individual's parent or legal guardian. So again, this is probably not as common, but it could help your child qualify for a mortgage. So it gives you that has that additional incentive because we get to count that income. So keep that in mind. Credit assessment. So the only thing really here for mortgages, where not all borrowers have a usable credit score. So they're basically, just to keep in mind, there's opportunities if you don't have a usable credit score that you can still get a mortgage. There's a couple different ones in here to go over. I would just say if you don't have a usable credit score, you would want to look up here. You see 5201. This is where I'm at, 5201 credit assessment, loan product advisor. Take a look into that. It's not common, but there are certain instances where you may not have a usable credit score or you don't have credit. You may want to look more into that situation. They do have some restrictions. Probably want to stay around bars where there is no credit score. They will apply the following requirements. It must be a purchase or no cash out. Must be secured by a 1-unit property. Must not exceed 95%. Must be a fixed rate mortgage. It must not be manufactured. It must not be a high cost or a super conforming. There's additional requirements. Payment references, most recent 12 months, housing payment history from your rent or whatever it is for all party other than housing. So there's a decent amount. I will say very few lenders will extend credit at that point if you do not have a credit score. It's very unlikely, but there is a possibility if you find the right lender. Authorized user trade lines, they usually go bye-bye. So if it's an authorized user, most lenders just say no because you're not obligated to pay that debt. They're just allowed to contact you because you're a signer on the account, but you're not obligated to pay that debt. So we can always ignore that. Inquiries, don't have a ton of inquiries. We have to explain them. So don't take out and have inquiries through that process just because no matter the program, we have to explain those inquiries, see if you incurred any other debt. So we will know if you took out debt during the process. Do not take out debt. I'm sure you've probably heard that before from other lenders. And we've all experienced our clients taking out debt, no matter how much we tell them. So if we look here, I believe this is derogatory credit, adverse action. There are ways to get around derogatory credit. So here it's, although there may be many situations involving derogatory credit information that are less clear, especially when disputes about obligations are involved. The derogatory credit information is not significant when it consists only of isolated late payments, even if several accounts show sporadic late payments, providing all of the following exist. So again, these are what would be considered non-significant. So late payments that were not recent, they did not extend beyond 1 month. The size and number of delinquent accounts is not large in relation to the overall credit. So if we had like a couple $50 that were derogatory for whatever reason from a long time ago, it's not going to have a lot of weight. It's not significant. If you look down here though, 60 to 90 day late payments, basically consistent late. That's the big one. A lot of delinquencies, multiple episodes. So there's a whole evaluation that's done. A lot of it's through the loan processor, but we will look as well to evaluate this. Usually, for the most part, most people, LP, loan processor for Freddie, and then DU for Fannie, whatever they say, it's usually going to do this whole analysis in their automated system, and most lenders will go off of that. Some have their own overlays on top of that, but for the most part, that's what they're gonna go off of. Seller decides derogatory information is not significant. So if we determine the lender is the seller, then we must provide supporting documents. So we need to prove why it's not significant. Extenuating circumstances or financial management, you have opportunities. So if you had a divorce, you had a medical ailment, what I like to tell people is if you were out in the hospital and you were in a coma for 3 years and you couldn't pay your debts, that's obviously an extenuating circumstance. You went to the hospital for one day because you broke your finger and then you came back to work a month later and you were fine and whatnot, that's not an extenuating circumstance. So keep like put it into perspective. And then your extenuating circumstance, as a loan officer, we're going to want to believe you, because this comes up more than you would think. We want to believe you. We want to say, yes, you had an extenuating circumstance, but we have to take the position that if you want to voluntarily prove, feel free. Send us whatever you want to prove. I can't obligate you to provide medical records. Well, that's never going to ever be allowed. But if you want an extenuating circumstance to be actually proved, like, hey, yes, I had you have to prove it to us. Otherwise, we're required to say, like, we don't believe you. We can't take someone's word for it on an extenuating circumstance. It doesn't work like that. There has to be some sort of evidence for us to say, okay, we will believe you. So sometimes a letter of explanation will fly, but it's not likely that you can just do it with the letter of explanation. Just depends. Key things here, foreclosure. So with extenuating circumstances, it's only 3 years for a foreclosure. So remember, that's the sheriff's sale. That's not when your mortgage company said you're foreclosed. It's when it actually sold. Deed in lieu, 24 months. Short sale, 24 months. These are all extenuating circumstance, 24 months from the discharge or dismissal. There's an other, whatever the other is, 24 months. So a couple key things there. If it's just, so financial management, I would just say this also falls under the standard. Foreclosure is going to be 7 years. Deed in lieu is 4 months. 48 months, 4 years for deed in lieu. 4 years for short sale. 4 years for bankruptcy, discharge, or dismissal. 24 for discharge date. 48 months for, or 4 years for the dismissal of Chapter 13. That's the one you'll see more. Bankruptcies, filings, multiple. You have to do 5 years from the most recent if you had multiple bankruptcies, and other is 48. So those are probably the key parts. Age of accounts, and that's So balance to high limit. So they're like these are just strong factors that affect you. So the age of your accounts affect your credit. Balances to limits affect your credit. Well, this is credit score 620 is the minimum. Again, it's a little bit more tough. Same thing with Fannie to get approved if you're 620 to 639 in this market right now. Once COVID has more, we have more reprieve from COVID. I think the 620, 639 bucket will get approved more like it used to. But right now it's still kind of that 640 plus window is where they really want you to be. But you still can, certain compensating factors at 620 to 639. If you got a lot of money and you're willing to do a 20 or 15 year term, you're probably going to get approved. So if your debt to income ratio is 20% and you have 2 years of history, 2 years of money saved in a retirement account somewhere, probably going to get approved, as long as your history reflects that you have a relatively good pay history for the most part. No charge-offs, things like that. I have definitely got many of those done before. They like to see a shorter, sometimes they just don't like the 30 years. They say it's too long for you. But we'll do a loan with you and back you for 15 or 20. So it gives you the opportunity to do that. Another borrower, so some key things, you can actually remove trade lines if another borrower on the mortgage owns the trade line in question. I would say you're going to be looking at more of this section. The borrower has been making the payments on the account for the last 12 months. It's not going to really show on your credit if you don't own it. There's a rare case that you could show proof that the other person actually owns it. You're not anywhere on it, then yes, technically we could remove that. It's more of an authorized user situation. And in that case, again, we're going to automatically remove it. I will also say that if you have less than 12 months left to pay on an account, it is automatically, it's not removed from your debt to income, but it's automatically removed from the findings. Okay, so it does help you if something is less than 12 months. So that is really good to know. If you have less than 12 months to pay on a debt. General requirements, so ideally stable income, asset qualification. So you have W-2 income, you have self-employed income. Self-employed, you need tax returns. Your W-2, you need W-2s. You need pay stubs. Your 1099, you need tax returns. If you own your own business, you need your tax returns. however you want to position your income, your employment, it's going to be the same. Freddie typically has less document requirementation than Fannie. So if we need to utilize 1 year of tax returns, because your last year, the prior year was not very good, but this past year was amazing. That the most recent year you filed, of course, and you've been in business for 5 years, that's the route you go Freddie. Because if you go Fannie, you have to do a 2-year average. So just key points there. All the other stuff tends to be the same. That's really the only key one with Freddie as far as income goes. Otherwise, you typically need 1 year of W-2 versus 2. Fannie is starting to catch on board with the 1 year of W-2. We need, IRS transcripts. All loans that you are self-employed, we need IRS transcripts. And we need the record of account transcript, not just the wage income transcript. Doesn't matter if you file or not. Secondary employment, I'll just say this, you need 2-year history. There's some instances where you can do less than 2 year. Most lenders want to see 2 year because it's uncommon for you to hold 2 jobs consistently for 2 years on a routine basis. So you typically want to see 2 years. Some instances you can do less than 2 years for a second job because it's looked at like part-time employment at that point. Income commencing after note date. So if you're starting new employment, you have a future salary or an increase. So either starting new employment or a future salary. You basically have to have the mortgage payments in savings for the period from when you close that loan to when you start your job. So if you have a 2-month window, you need 2 months plus typically another 2 months of reserve on top of that. So if you're going to start it in 4 months, you then want to see 2 months from when you close the loan plus those additional months. So just figure I'm going to have a future salary. I'm starting a job in 90 days from when I close the note. That's doable. Number one, that's only doable or allowed by a lender who's willing to service that loan for 3 months. Not many companies are. So you have to see, are you guys willing to service your mortgage? If they say we sell them immediately or we sell them in general, then you're going to go ahead and say you're not going to be the one who's going to be able to help me. There you go. There's your answer. If they say yes, we will service them for any short period of time, any time at all, they will probably do that for you. So if you do have employment that is to start within 90 days after you close that loan, the note date, you sign that note, then there you go. You can actually use that income, which is actually pretty nice. So very, very cool factor there. A lot of people think they have to have the income or the pay stubs, and there's some loan officers who actually request those pay stubs out from people, and I'm like, man, come on. Got to know your guidelines. That's why we're doing this. Now you're going to be more educated than these other loan officers. What the heck's going on here? Additional employed income, commission, bonus, overtime. A lot of this stuff's average. Most of this other stuff's average. So if you have something that's uncommon, or you do have like the common commission, bonus, overtime to your average, things like that. Anything that we haven't gone over, just let me know. Drop a comment, reach out to me on one of my social media accounts, drop me a DM. I'd prefer that. It is a lot easier for me to get notified in that manner. Helps out. Self-employed income, it's an analysis of your income. There's certain things you get to add back in and whatnot. Other things that you have to deduct, like meals and entertainment, things like that. It's actually pretty simple. A lot of people screw it up. So I'll just say, just make sure that you work with someone who is vetted. Always work with someone vetted. If they're not vetted, don't call into a call center. You're going to shoot yourself in the foot 9 times out of 10. So you just want to make sure you're working with someone that has been vetted, who has done self-employed income before, and that way you know this person's going to do it. A lot of people get it wrong. If you need help with calculating your self-employed income, drop me a DM. Comment below. Love to calculate your self-employed income. I love self-employed income. I do it all day long. It is easy. It is so simple, and so many people get it wrong. There's even worksheets out there. If you want a worksheet, let me know. I'd be glad to send one to you. Most of this other stuff, again, I'm not really going to get into it. We already went over the bulk or the majority of the main common items. I will say the only other one is student loans. So student loans with Freddie, you cannot use an income-based repayment plan, but what you can use is 0.5%. So if you look at FHA or you look at Fannie, for example, you're looking at 1%. If you have an income-based repayment plan, that's where you want to go Fannie, because you can do 0 or whatever that payment plan is. It could be it's typically 0 or something way less than even 0.5%. But if you don't have an income-based repayment plan, then Freddie's the one you want to go because you get to use 0.5% over 1%. So Freddie would be the one if you don't have an income-based repayment plan for student loans. And I've gotten there's a lot of people who will actually qualify for Fannie and Freddie that don't qualify for FHA. And that's because of the standpoint that I get to use 0.5% or the income-based repayment plan. So their debt to income would be 60 or 65% with FHA, which you're well not qualifying for. But you could have a 45% or 43% debt to income ratio with Fannie and Freddie, and as long as you have like the other factors, the reserves or down payment, or you have the debt to income ratio, you have the whatever you need, typically good credit history, things like that to qualify, they'll approve you. And that's the way I've gotten many people approved, where again, they can't get approved elsewhere, because let's say that you have $120,000 in student loan debt. Imagine if I have to count $1,200 a month against you just because they're all deferred. It's 1%. Not fun. Property eligibility, just talk to your loan officer about that. Depends on the property. That's why you always want to do what's called a pre-offer review that I tell people to do. So a pre-offer review is going to be, you're pre-approved. Before you put in that offer, you're running that address by that loan officer. Make sure you do that. That is very, very essential. By not doing that, you're shooting yourself in the foot, because most loan officers will not ask you to do a pre-offer review when they go over a full pre-approval presentation with you. And then you go to put in an offer, and yes, the home price was a little bit less, but guess what? That home has $500 in HOA dues. You no longer qualify. Uh-oh. I guess that $175,000 pre-approval wasn't actually good. Or maybe the loan officer didn't do their job. We are trying. So one of the key things you'll see me as this podcast goes on is I'm here to educate consumers, and I'm here to correct and prepare you so that you're a sitting duck. You're not relying solely or heavily on a loan officer, because most loan officers are call center based. There are some who are what are called retail, who are just really good at sales, but they've linked up with however many realtors, and they're not doing pre-offer reviews. And so if you're not getting this presentation and you're relying on the loan officer, and that loan officer doesn't do a pre-offer review with you, they're just telling you, oh, hey, guess what? We just went 2 weeks through the process. We have HOA dues here. Uh-oh, you don't qualify. You just lost your earnest money. That's really the loan officer's fault, but technically they'll say it's your fault too. So you don't want to be in that position. Always make sure that you do a pre-offer review with that loan officer. I don't care who it is, who you're working with. Make sure you're running that address and all of those numbers by that loan officer. The taxes, the HOA dues, whatever's encompassed with that property, do research, pull the tax bill. It's online. You can Google the tax bill for almost every county in the country. Google it, find it, search it, send it, and make sure the loan officer puts together a new presentation, or at least gives you the new numbers, it ensures that you qualify. Or you can take it a step further and just say, hey, I want you just to screenshot that I got an approved eligible on this date. And they could screenshot the top of the findings. You don't need to get all the findings. But if you saw 516 or whatever, or 618 if it was today, approved eligible, and the loan amount, you can see the loan amount on there in the findings just to show that for that property, like not that property, but that loan amount, because you don't want to trigger disclosures yet. We don't have an accepted offer. But that loan amount, that interest rate, it all is approved. And that's key. You can even do that, and they should be willing, no problem, to do that for you. So, a lot of good stuff today. A lot that was here in Freddie. Certainly many similarities to Fannie. A lot of Fannie and Freddie, they have the same products. They always correspond with each other, and then they just have little minor differences. And now you know a little bit more, not just about the girl, but also about the boy. We got Fannie, Freddie, and next week we'll be going over, or next session, it's every 2 weeks, we'll be going over FHA. I might split that up into two because there's a lot that happens with FHA. We'll see. But I hope you learned a lot today. We had a good time. Give me your feedback. Let me know what you think. These first ones are going to be a little bit more boring. I'm expecting that. But let me know what you think about this. If you have any comments, any questions, again, I prefer if you do DM me on one of my social media links. But if not, and you want to drop a comment below, feel free to do that as well. And I'll get back to you as soon as I can. I'd love to hear what you guys have to say. Thanks for tuning into the Mortgage Guy Podcast. I should say the Mortgage Guy Podcast. Say a little bit more fluid, not the Mortgage Guy. I do have a sense of humor, people. I'm not just a nerd behind a desk that reads guidelines all day. Although I do state them a lot. A lot. People just call me, hey Darian, what's this guideline? Oh, you know, the Mortgage Guy, here I am. Well, I hope you guys had a wonderful day. Thank you for tuning in, and I look forward to talking next time. Thank you for tuning in today to the Mortgage Guy Podcast. Make sure to follow me wherever you listen to your podcast on iTunes, Spotify, or my YouTube channel. And you can follow me as well on all social media platforms.